Right now, there's been a lot of tax talk in the lead up to the federal election, with both Labor and the coalition proposing significant changes that promise to deliver major tax savings. And yet the policies are quite different in nature. That said, with so many different tax announcements and proposals, it can be quite hard to wrap your head around it all and get a clear idea of which party is going to make you better off. So we've brought in an expert to explain it all, and that's the Director of Tax Communications at H&R Block, Mark Chapman. G'day, Mark. Welcome to the Savings Tip Jar.
It's a great pleasure. How are you?
Very well, Mark. Thanks for being on again. I think last time you were on was episode 67. We're now up to 102 now. And I think last time we were talking about tax deductions at after 30th of June. And then before that, you're on very early on, episode 22. So good to have you back. But before we launch into all that tax stuff that Dom just mentioned, I understand you have a savings tip for us. And, lo and behold, it's tax related.
Yes, well, we're heading towards the end of financial year now. So I'd just like to emphasize really the importance of keeping proper records, particularly for all of your work-related expenses. You do need to keep a receipt or an invoice for all of those expenses. So it is worthwhile, now we're getting towards the end of the tax year, to basically spend some time going through your books, making sure that you've actually got those expenses, or those receipts, those invoices to support the deductions. If you haven't, you might want to consider basically getting in touch with the retailer and try to get a duplicate. Or otherwise, you're potentially losing out on a tax deduction. So it is very essential, very important that you do keep those receipts, invoices. Even if you might not ultimately be able to claim a deduction, it is worthwhile keeping them just so you can check with your accountant at tax time.
Yeah, certainly. Good tip, Mark. I've definitely gotten into the habit now of whenever I get a receipt for a lot of things, I just by default take a photo of it, so it's in my phone, and because it goes into my Google Photos, I can actually just search. I just type in the word receipts, and it'll bring up all the receipts, and I can easily find receipts that way rather than scrolling through the whole thing. But yeah, we've all been there. Okay, so speaking of tax deductions, we've heard a lot of announcements in lead up to this election, but very different ways of tackling tax savings. Can you just give us a brief overview of the major tax policies and proposals on both sides leading up into this election?
Yeah, well, the sort of key elements of Labour's plan is to introduce a standard $1,000 tax deduction. So from the 1st of July 2026, they're proposing to bring in this deduction, which will enable you to claim $1,000 for work-related expenses without actually the need for receipts. So that goes back to what we were just talking about. So the Labour Party says that will benefit approximately 6 million workers who currently claim less than this amount. Obviously, if you are currently claiming less than $1,000, then in effect this is a tax cut because you will get $1,000. So if you're only claiming, $100, in effect it works out as a $900 tax cut. They're also proposing to reduce the bottom rate of income tax. So from the 1st of July 2026, they're proposing that it will go down from 16% to 15%, and then the following year it will fall again to 14%. The actual impact of that will be fairly minimal. It's worth $5-10 to every taxpayer. Basically a cup of coffee. Each week. Yes. So not huge impact, but eye-catching. And in terms of the coalition, they're proposing to introduce a one-off $1,200 tax offset. So this is very similar to the old LMITO, low middle income tax offset, which
Lamington.
Yes, which seems to have only just disappeared. It disappeared about 2 years ago. So basically, the coalition is proposing to bring that back as a cost of living tax offset. So it'll work in exactly the same way. You'll get it when you lodge your tax return. It'll be paid as a lump sum. that does mean that taxpayers do need to lodge a tax return in order to get it. And also, they're proposing to make mortgage interest tax deductible for certain home buyers. So, first home buyers basically can deduct interest on the first $650,000 of their mortgage from their taxable income. That only applies, however, to new build house purchases, not to existing house purchases. So that is a very rough overview of both parties' proposals. So over to you guys. If you want me to talk about any of them in more detail, I'm happy to.
Yeah, we'll talk about the mortgage interest deduction a little bit later, but we'll just go with those deductions and the new Lamington 2.0. Obviously, the Labor policy puts the power in the taxpayers' hands in the sense that they need to then deduct that off their tax return. And we've sort of seen that with the kind of COVID era work from home deductions and things like that. But what's going to be better? Because I think last time you're on the pod, Mark, you said that you yourself use the flat rate deduction method. What's someone like you going to do at tax time? Are you going to just write off that $1,000 instantly, or are you going to go the actual deduction method to perhaps yield more at the expense of more work?
Yeah, well, I mean, this $1,000 instant tax deduction is really only worthwhile if you do actually claim less than $1,000. So if you're in a position where you can claim more than $1,000, which I do, I claim professional subscriptions to various accounting bodies, etc. So my work-related deductions come to more than $1,000. This isn't really this proposal isn't really very significant. It isn't significant at all. So you'll continue to claim deductions in the existing way, which means you do need to keep your receipts, your invoices, etc., your bank statements. But in a situation where you are claiming more than $1,000, if you're claiming less than $1,000, it is, as I say, quite attractive because it potentially works as an effective tax cut for you. It does mean that you don't need to keep those receipts, that substantiation for those expenses up to $1,000. It should potentially save time and money for taxpayers who won't, well, in theory at least, need to keep their receipts or the invoices to substantiate $1,000 deductions. However, in practice, many taxpayers will still need to keep full substantiation, as they won't necessarily know whether their work-related expenses are going to be more or less than $1,000 until they get to the end of the tax year. So, I don't want to oversell this no substantiation rule because it simply won't apply to many taxpayers who do, as I say, need to keep the substantiation in order to work out whether they are going to have less than $1,000 or more than $1,000. Obviously, this means that the ATO won't need to audit taxpayers who claim the standard deduction. However, that does mean that will enable them to shuffle resources about to focus on higher tax claims, which means that there'll be more pressure on taxpayers to make sure they have the necessary records to support their claim in relation to any of those deductions over $1,000. And it's worth pointing out that there's already a $300 limit. You can already claim up to $300 in work-related expenses without substantiation. That's an ATO rule. So in effect, this is simply extending that, I suppose, to $1,000. It's slightly more generous. So it's not a fantastic proposal, but it is going to be a worthwhile proposal if you're simply claiming if you're recording your income and you are claiming less than $1,000 in deductions, in work-related deductions.
Mark, do the tax savings, depending on which party gets up, vary quite differently depending on which demographic you're in? One of the ones the coalition are proposing is the reduction in the fuel excise, which I imagine would, for people who drive a lot, that will result in huge savings. But perhaps for those that maybe don't drive so much and catch public transport, would the Labor Party's tax policies have better savings for them, or is it about even?
Yeah, it is very much that the Labour policies are pitched at lower and middle income taxpayers. The vast bulk of the benefit will fall on those lower and middle income taxpayers in terms of the standard tax deduction, in terms of the reduction of the bottom rate of income tax. With the coalition, however, it's aimed at a slightly higher earning demographic. So, this new tax offset, for example, won't kick in unless you earn at least $48,000. It will apply through till $144,000. So if you are in that bracket, you will get some benefit. The maximum benefit will be between $48,000 and $104,000 actually. So it is pitched at a slightly higher earnings level than the Labour proposals. And they've got their various other tax proposals out there, such as the fuel policy, which again will tend to impact those taxpayers who drive to work, who may not necessarily be well off, but you just got to break it down into each component to see which actual demographic actually benefits.
Yeah, for sure, Mark. We'll move slightly now to the mortgage interest deduction policy put forth by the coalition. To me, it sounds really complicated, and if you're taking part of the scheme, in my personal opinion, you might need to start enlisting the help of a tax professional. What's your take on it from a tax perspective? Is it an effective deduction? And what are the kind of long-term outcomes of a policy? Could this just induce demand and serve to drive house prices up further?
Yeah, well, I mean, I'll deal with your second question in a moment, but in terms of the actual mechanics of claiming this deduction, you do need to meet certain criteria. So you need to be purchasing your first home to actually live in. So it needs to be a principal residence. It can't be an investment property. You need to earn less than $175,000 if you're an individual, or $250,000 if you are a joint applicant. And you do need to be purchasing newly built homes. That means homes that get to be occupied, including off-the-plan apartments. So you can't claim an existing. You can't buy an existing property and use this scheme. So that basically will narrow the eligibility. But with it, provided you do meet those criteria, then you can claim up to the interest on the first $650,000 of the loan. There isn't actually any cap on the actual house price that you can purchase, but in all cases there is a restriction on the amount of interest which you can claim, which is on the first $650,000 of the loan, and thereafter you do actually lose the tax deduction. So, in terms of that's the tax side. Those are the mechanics of the tax side. So it's quite a useful deduction. It could potentially lead to, say, if you're earning $120,000, you've got a $650,000 mortgage, you could potentially benefit to the tune of around $12,000 a year, which sounds quite generous if you put it that way. But you've really got to look at the sort of flow-through effects of this policy. What will be the impact on the housing market? And I think we've seen, from other examples of overseas governments who've introduced similar policies, like the Netherlands, for example, is that the only impact really is that it tends to drive house prices even higher. So although you're getting $12,000 a year tax benefit, ultimately you might well end up paying at least that much in the cost of buying an additional house, because it's a measure to boost demand. They're not really doing anything. Either party really aren't doing anything to address actual housing supply. So if they're simply boosting housing demand, then inevitably the end result is higher house prices, and the real beneficiaries are actually the people who are selling houses. Whether they're new or existing. This works as an effective transfer, if you like, of resources to house sellers from house buyers, which is kind of counterintuitive, but nevertheless, that is the result from, as we've seen in Netherlands, Denmark, etc., other countries which have tried similar schemes.
Now, Mark, just hearing that overview of all the different policies that have been announced in the lead up to this election, I get the sense that these don't represent substantial, significant tax reform. They're just little carrots that they're dangling out to just win a few extra votes. Now, we did hear last week Dutton mentioned that they have an aspiration to one day eventually index the tax brackets to inflation, which perhaps that would represent significant tax reform. And yet it's just an aspiration rather than a locked-in promise. Do you think there is still a significant need in this country for substantial tax reform like that?
Yeah, well, indexing the thresholds would be a very sensible measure. It would eliminate bracket creep because as your wage increases, so does the tax threshold. So therefore, there won't be that impact from bracket creep. Having said that, although it is a very sensible and wise policy, it has to be said that the coalition has only expressed it as an aspiration. So they haven't said that they are going to do it. So really, an aspiration isn't really good enough. It'd be good to see one of the two parties actually committing to indexation as a policy, not just an aspiration. Really, an aspiration isn't really worth the paper it's written on at the moment. So I think we can take that with a slight pinch of salt just at this particular time.
Yeah, for sure. I mean, we can all dream, can't we, that our tax bill, won't further fuel, I guess, government spending, and that they might have an incentive to keep inflation down because that means they don't have to index the brackets so much.
At least it's in the conversation
so hard.
now.
So, Mark Chapman, we really appreciate your time on the Savings Tip Jar podcast. Thanks for all those insights.
Okay, it's a great pleasure. Thank you.
Thanks, Mark. Cheers.